In this lecture we are going to analyze a simple manipulation maneuver in the Australian dollar 1-hour timeframe. This example is a little different because the von Riestorff effect seems to be absent, at least in the way it usually appears on most market manipulations. However, we have other strong elements that point to the validity of the manipulation in question. Let's jump into the analysis to see what's going on in this chart. Just by looking at the chart we can tell that the market has been rising, and therefore we have an upward motion. You can argue that this is a very vague way of establishing the trend, and you would be correct, but remember that retail traders think in this simplistic manner. One of the things you must be able to do is to put yourself in the shoes of the retail traders. When they see a chart like this, they are thinking about going long for sure. That's certainly the case when retail traders find themselves around low number 2. When they are around that level, they are immediately attracted to high number 1 because they cannot help to think that 1 is a good place to go long. Naturally, large masses of retail traders think exactly the same thing simultaneously. This creates a cluster of long orders at the high number 1 level. As I said in the beginning, the von Riestorff effect is absent here in its most obvious form. Maybe not absent in general, but we don't have any large candles shooting up near the high 1 after the low 2 occurred. We do have something interesting though, which is the pounding of lows right before high number 1 was broken in 3. Take a look at the series of green upward arrows I drew in the chart. Right before price broke the high 1 in candle 3, we can see a price signature. All that means is that large traders were deliberately pounding those lows to tilt the market up to high 1. Notice how those tails have a certain degree of order between them. They don't seem to be random at all, and that's because they are not. The fact that large traders had to pound those candles up means that there was already a lot of selling pressure in this market. Maybe that would explain the lack of an obvious von Riestorff effect, and also the fact that high 1 was just slightly poked. Candle 3 is what does the trick for the large traders. The high of candle 3 pokes the cluster of orders created by retail traders. That by itself creates a deep liquidity pool and increases the market depth of that market level naturally. This is the moment where large traders can sneak in their massive positions, which in this case would be for the selling side. You can tell that by the size of the upper tail in the candle 3. After candle 3 closed, the retail traders are already stopped out or very worried. Here the reverse psychology and bandwagon effect begin to take place in that way that must be boring you by now. Retail traders suddenly realize that they were probably mistaken about their long trade idea, and they are starting to take the reverse position to recuperate their losses. It's amazing to see how they never learn their lesson and they keep making the same mistakes repeatedly. Since large traders are already holding a sell position, the fact that retail traders are also jumping into the selling side only helps drive the market down and make money for the large traders. If retail traders had some degree of discipline and were able to hold their positions, they could in fact make their money back, but they lack operational ethics, so they usually close their positions as soon as they see some profit in the terminal. A really bad case of hyperbolic discounting to say the least. After candle 3 is closed, we already have the correct context for a trade based on our analysis. Observe that I drew a black horizontal wash line and a red sloped wash line. Notice how many times price tests the sloped wash line inside the red rectangle I drew. That's a very strong indication that this is the line we should be looking at. After candle 3 closed, we had 2 chances to go short in the red sloped wash line when price touched it. The position you see in this chart was opened at the second and last chance before price started falling, which is marked by the second red arrow. The stop is above the high of the candle that was used to manipulate the market as usual, and the target is a low that is apparently significant in the chart. Let's see how the market develops. As you can see here, our analysis of the market was correct and our target was successfully hit. This is the type of trades and the type of precision you can have once you master the way large traders think.